Welcome to NDTV Profit. I'm Harsh Saita. We have a very, very special guest with us on this show, and it's a special show as well. You know, the guest is not only a successful entrepreneur, which is, of course, a difficult thing to do, but he's also a very, very sharp investor. He started his company in 1997 when the word startup was more frowned upon in India than respected. And he has since silently disrupted several spaces. And in doing so, he's built an $11 billion company from scratch in the last 27 years. That is saying something. The company has disrupted the recruitment business through Naukri, real estate broking business through 99 Acres, the marriage business via Jeevansathi, and educational services business through Shiksha. But it doesn't stop there. He has thereafter gone on to acquire stakes in companies that have disrupted the Indian marketplace altogether, most notably Zomato and PB Fintech. The guest I have the pleasure of speaking with today is Mr. Sanjeev Bikhchandani, the founder and vice chairman at InfoEdge. Welcome, sir. It's an absolute pleasure.
Thank you for calling me. Pleasure to be here.
Right. So I'm going to first start off with just trying to understand how you view India as a marketplace, both as an investor as well as a promoter or rather a business person. How do you view the market? Because you largely done consumer tech, and therefore, how should the market really look like to you? It's 140 crore in all, but is that really the market size?
Yes, no. In the sense that the purchasing power for several of our products and services is perhaps the fraction of the people. That fraction is growing larger. And as India gets more prosperous and as economic growth continues, we expect that this market will only grow larger. And I come from a perspective, when we launched Naukri in April 97, there were only 14,000 internet accounts in the country. And so from there, we've come a long way. And we've seen those days and survived. So I think the future is only better and brighter.
Right. So if one were to look at, you as an investor were to look at a particular company, say a Zomato or a PB Fintech, say in 2008, when you did invest in some of these companies, what was the thought process? What were you thinking about? How were you looking at the opportunity at that point?
So we typically don't do, total addressable market. We don't do TAM analysis. What is total addressable market? Because we believe TAM will work its way. India is growing, the internet is growing. If the founders are bright and committed, they will figure out the TAM. Okay? What we look at is what they're trying to do useful, and two, are the people good and committed, and will they stay for the long haul? If both these questions are answered, and as yes, then we know that this company is in with a shot. Then we go further, and then in India you have to be patient because from inception to IPO, typically a company takes 10 to 15 years. The real value is created after the IPO. It's a good company. So I would say that be patient. Founders are good. It'll work itself out.
Okay, so you've covered a couple of points here, and I'll try to break it up. I'll first talk about founders, because patience is more driven from an investor standpoint, which is from your standpoint. But just talk to us about the founder factor, as well as maybe another one or two factors that you look at outside of the founder that attract you to a particular company if you were to invest in.
इंडिया में कंपनी बनाने के लिए कम से कम 10 साल लगते हैं, ठीक है, और अंतर्मन का तेल निकल जाता है. So you got to have founders who are committed, who are courageous, who will go the distance, who are not interested in flipping in 3 years' time, who want to build large companies. That's when you can be patient. If the founder is not patient, how can the investor be patient? So both founder and investor have to be willing to be there for the long haul. Right now, apart from founder and idea, Of course, you look at network effect, you look at IP being built, you look at competition, you look at a whole bunch of other things, right? But those are all things you look at after we are comfortable with the founder and the idea.
Right, so one of the unique things about what you've done is, one, you've of course you have niche for catching good companies, but you have also got a very, very high hit rate for that. Just talk to us about how do you judge what really stands out when you pick your companies?
I think it's people and idea. You see, what we believe is that most successful businesses are built on deep customer insights about some unsolved problem. So you got to see what is the customer insight, what is the unsolved problem they're solving, and you got to look at quality of people, how committed they are, how capable they are, their integrity. And very often you're making judgment calls on a young person's capabilities 10 years out, 5 years out, 7 years out. And you sometimes get those wrong. We've been fortunate. We've got it right many times on people. We've done about 100 startups. We've been wrong on people maybe 2-3 times. But by and large, we've been right about people. And once you get beyond people and customer insight and unsolved problem, you get to areas like competition, network effect, IP, cost structures, unit economics, all those things.
But sir, to you, those things are more secondary. Is that how you look at it?
Well, let me put it this way. There's in calculus and maths, in differential calculus, there's a necessary condition and a sufficient condition. So necessary condition is, customer insight, unsolved problem, and quality of people. Sufficient conditions are the remaining stuff. You need both.
Got it. I'll come to the second point you made. So 2 ingredients. One was good people with persistence. The other one is investors being more patient, which you've clearly demonstrated. So talk to us about how you think of the long haul, because there are times when investments can get to a certain extent egregiously valued, or investments just don't turn around. When is it that you decide that, all right, here's the end of it?
So look, I think we respect all entrepreneurs. We invest behind, including those we didn't invest behind. Because see, entrepreneurs take a risk with their lives, and that you need to acknowledge and respect that. Now, having said that, sometimes things don't work out. So patient, you will keep giving the company time. Question is, will you keep giving it money? And there will come a point when maybe you don't have the confidence to keep on giving more and more money, and maybe there are no other investors there. And when that happens, then you have to take a call, yes or no. So giving time is never a problem. Keeping on giving money is where the rubber hits the road.
Right. So when is it? What are those maybe 3 or 4 key red flags for you, where you would possibly not give the company or the investee company more time, money of course, but time more importantly?
We give infinite time.
Okay.
Right? We don't give infinite money.
Got it.
Now, when do you say no more money is when there is no external market validation, there's no inbound interest from other VCs. The unit economics are not getting, are not becoming okay. It is unclear when they will become okay. There is no clear path to profit emerging, and you've been trying for 5-7 years. The entrepreneur himself or herself is getting tired. These are all red flags, which you will then look at a company and then figure out.
Right. And sir, maybe through a story, through an experience, if at all, the 2-3 key mistakes that you feel you have made or learned, or your learnings from some of those mistakes or mistakes of others, if at all, any.
So I think some of the corporate governance lapses that have emerged in the Indian startups, in the Indian startup space in the last 5-7 years, some of those are of concern and should be of concern to every investor. it should also be of concern to honest founders, because if there are too many corporate governance lapses in startups, people will lose trust in the sector and they themselves get hurt. So I think corporate governance is a big area where all investors and startups need to work on.
All right, so corporate governance, we'll come to that. I want to stay focused on the startup side of things, or rather from the investor lens. You know, you've picked companies which have started to hit a J curve. You've picked them very, very early, sir, and that's really helped you stand out even in terms of your returns that you've made from some of those investments. Is there a specific formula to determine what helps the company achieve the J curve and to accelerate that, if at all?
I think persistence, resilience. I think a sharp focus on customers, continuous innovation, investment in technology. These are some of the attributes of some of our successful companies and entrepreneurs, right? India needs patient capital. As an investor, we have to be patient. I recall speaking to the late Mr. Rakesh Jhunjhunwaala about 4 or 5 years ago, maybe 6 years ago. It was COVID time and it was a Zoom call. I had just called him up. And he told me one very important thing. He said, Sanjeev, if you find a truly great company, then stay forever. You don't have to exit. And if you stay forever, you can make huge returns in the years to come. He said, that's how I made my returns in Titan. I stayed for a long, long time. I'm still staying. And you need to be very, very patient.
And how does valuation play a role in some of these factors? Because you're looking at a very large addressable market, may not be 140 crore, but at the same time, some of the companies at early stage may not be profit making. And at the same time, they may take some time to hit a J curve. And therefore, how should one look at valuations, whether you're underpaying, overpaying, or that is not relevant at all?
So we are valuation sensitive. And high valuations, we would like external validation of other investors wanting to come in or coming in. Now, having said that, we went solo in Zomato in the first 4 rounds, but each time against a competitive term sheet. And the reason what gave us confidence was the quality of the team and the fact that the customer love that they were getting. The fact that, the users really loved what they're doing. And that's important. If users love you, the rest you can figure out.
And were you concerned about the exodus from at least the top level at Zomato, given your large focus on people running institutions?
There was never an exodus. There have been some departures.
Yes.
But each time I would call up Dipinder and ask him, is everything okay? He'd say yes. I said, are you sure? He said yes. Why did such and such person leave? And he would give me a logical answer. And if the founder, has that, we think it's okay.
All right. I get your point. And, you got into consumer tech fairly early. Where do you feel the next bunch of opportunities are going to come from? Let's say, where's the large value creation going to happen at least between 2030 and 2040? Say, example,
Okay.
if you were to pin a dart.
So we are not in the predictions business. We're not good at that.
Right.
So we don't do it top down. We don't look at, okay, which sector is going to be big and what's going to happen and where should we therefore invest. We just meet and study and analyze, or at least a preliminary analysis of maybe 1,000 companies every quarter. We have a team of 15 or 18 people doing it. And we prefer to do it bottom up, where we are meeting entrepreneurs and figuring out who's doing what and what makes sense. So we don't have a predetermined idea of which sector. We just go and meet everybody and see what's bubbling through from down under, and then we invest.
Understood. So sorry. Yeah.
No. So in 2008, if you had told me that the insurance comparison space has potential, the space did not exist. I would have said, what is that? Or in 2010, you told me that restaurant listing space has potential. I would have said, no, I mean, there's no such thing. So when you are going into category creating companies, essentially the category does not exist prior to you're going in. And therefore, actually what you're doing is you are harnessing the imagination of the entrepreneurs and teams you're going behind. Whereas if you have a predetermined idea of what sectors, you are limiting yourself to your own imagination. And if you're talking to 1,000 teams, their collective imagination will be far ahead of yours. So we prefer to meet people and then figure out.
Right. And I'll switch focus more towards corporate governance because that's something you touched upon. It's such a subjective topic. Just give us your 3 or 4 key points that you look at in a company when you believe it's good corporate governance.
So look, when you're going in early, very often there's no product, or if there's a product, there's no revenue, or if there's revenue, it's very low revenue, and the team is small, right? So essentially you are making a judgment call on the person or the persons. Are they honest? Are they fundamentally honest? If they're fundamentally honest and they want to stay that way, right, you believe they will learn the rest along the way. Now, corporate governance as an organization grows and becomes more complex. While everybody wants to be honest and is trying to be honest, very often there are shades of gray which you need to navigate. And for example, if you are a company which is appointing franchisees, and you have, let's say, a 5 lakh rupee franchise fee upfront, should that be recognized as revenue this year, or should that be amortized over 4 or 5 years during the life of the franchise arrangement? Now, many entrepreneurs will use common sense and say, no, this is my money, I've got it, I'll recognize the revenue this year. Actually, you should be recognized over 4 or 5 years. Now, this is stuff where founders need sensitization, coaching around revenue recognition, around, what's the right way to recognize costs, okay? And what's, therefore, true and fair accounting. That's one aspect. Then there are areas of conflict of interest, convergence of interest. Then there are areas of related party transactions. These are all areas that founders need to be sensitized about. And if they surround themselves with good people, good investors, good board members, good auditors, and are willing to adopt the tenets of good governance, a lot of things will get solved. So corporate governance actually begins and ends in the founder's head. The rest is stuff around it, around the founder, which if the founder doesn't want to listen to, then you have a challenge.
And sir, how much do you advise or do you give a lending advice to some of your subsidiary companies, say for example a Zomato or PB Fintech, just trying to gauge how much of your thoughts go into their philosophy of how they operate?
First of all, they're not subsidiaries, they're associates, okay?
Sure.
Second, when they were much smaller, interaction was different. Now that they are large and more mature and listed, and they have independent boards, and in Zomato's case, they're even a larger market cap than InfoEdge. It's different, right? Now we are always available. Perhaps we are called upon less now than earlier, but there's a constant conversation. So, for example, I could be talking to Deepinder or Shant, who's the CFO in Zomato, maybe once or twice a week. I could be meeting them maybe 2-3 times a month. Often without an agenda, just shooting the breeze. I could be talking to 1 or 2 other directors on the board, and then taking it forward from there.
And
if there's a specific decision to be made, for example, should Zomato acquire the Paytm ticketing business or not, that could be 5 or 6 meetings, maybe maybe 7 or 8 meetings, usually on Zoom, sometimes in person.
Right, and do you, of course, for your smaller associates, for the smaller companies that you own stakes in, that may be more frequent. Is that what you were suggesting?
I mean, that would likely be quite frequent, but there's a whole team of 15, 20 people
Sure.
which are managing the portfolio. Therefore, there are different companies meeting different people all the time.
Right, and what would your advice to them be? Because that'll be very different from the advice you give to the more matured kind of companies.
It varies by company and by situation, by what are the milestones and tasks ahead, by what is what the company is doing well, what is not working, what is working. It varies from company to company. But in general, we like our companies to be capital efficient, to be frugal, to get to cash flow positive, maybe EBITDA positive, maybe, revenue should be growing. Okay. So that's our general stance, is that you must do what is commercially sound.
Right. Right. And with regard to IPO, right, you had Zomato listing at a time when it wasn't profit making. PB Fintech also in a very similar kind of a space. Were you comfortable of them listing at that point, or would you have liked a slightly more delayed listing? What was your advice to them at that point?
It was, look, if the market is ready to give you a listing, go for it. Make sure that you get to profit within 2-3 years. And make sure that's what you promise to the market. Don't promise anything that you can't achieve.
Right. So profitability would continue to hold the key. And what gave you the confidence, or
if not profit, at least path to profit.
Right. Right. But were you reasonably confident that that would happen? And what gave you that confidence? Something like a Zomato, something like a PB Fintech?
Well, we obviously, used to regular reviews with the company, and the board had been formed and set up. And the board would meet, and we'd kick the tires around the business plan and the last quarter performance. And we were reasonably confident that we were able to do it.
All right. So again, it was more your trust on the board and what the board was suggesting to you, rather than
the board was largely non-executive. It was our trust in the management team and the founders.
Right. I'm going to switch focus now, more from a company standpoint. If I were a startup, what's the single largest contributor to my success, if I can call it? If I were a startup, your advice?
Quality of the founding team and the management team. The people determine the likelihood of success. Because everything in early stage revolves around the people.
Right, and that's typically what you've always focused on. You've said that almost through the conversation. And what would be the right time for a startup to raise money? What would be the best case use in terms, just not money for the sake of money, of course, but what in your view would be the best case use, if at all one were to raise?
You should raise money, A, when you need it, B, when you're getting it. Raise a little bit more than you think you need, but not so much that, it burns a hole in your pocket. So raise it, but don't spend it. Don't spend it foolishly.
Right, and for how long would you delay profitability? Because we have a bunch of new age startups in India. That is currently the culture. For how long do you continue to burn? Is there a definitive timeline, or is there an inflection point, if you can give us advice?
It's largely driven by funds availability, as what I'm observing. If your competition is getting access to funds and is spending money, maybe you need to spend that kind of money to face competition, in which case you better be raising that money. When funding dries up, as it did towards the end of 2021, that is when, the wheat is separated from the chaff. That did you have a sound economic model? Do customers continue to buy you, even when you're not subsidizing you're not giving discounts? And so you got to be building a strong franchise, even if you're raising money. Raising money is not a substitute for building a good customer franchise.
And how should one balance profitability with growth? Because you're talking about one customer franchise, but you're also talking about unit economics getting better. So how, at what point should one prioritize profit over growth or growth over profit to try and build market share, build your franchise, thereafter tweak back towards profit? How should one balance that?
Actually, in my view, you can get high growth along with profitability. And if you're not doing that, it means you don't have enough customer pull, customer love. If you have to discount and subsidize to get growth, maybe you need to figure out what can you do with product offering to create pull that the customer comes anyway without a discount.
And IPO is only when you see paths to profitability, or do you believe that IPOing earlier also makes sense as long as the franchise is strong?
Well, you have to figure out the market will allow you to IPO, will it take you IPO? Right? In a buoyant market, you may get away with it. But what happens after 1 year or 2 years if the market corrects and you're still not profitable? So I think you need some predictability, you need some clear path to profit to be stable post-IPO in a market that may or may not be buoyant.
And how should one look at pricing the IPO? Should one price it at a level where there is enough appetite? Leave how much money on the table? Your views, because you speak of corporate governance. We've had so many IPOs come in, even within the main board, which haven't given the best returns to investors. What should one make in terms of pricing?
I would be a little conservative and not too aggressive. You want to leave enough on the table that incoming investors are happy. At the same time, you don't want to leave so much on the table that the earlier shareholders believe that they were shortchanged. It's a fine balance. But I would err on the side of perhaps underpricing the IPO.
All right. And underpricing, would you therefore, because some of these companies are not really profit making, how should one determine value?
I think your bankers who are taking you public, they will have a fair idea of where the appetite is of investors. And listen to that feedback very carefully. And you can push the envelope on their feedback a bit, but not too much.
Have you advised a Zomato, a PB Fintech, which have done very well now, but initially we saw a bit of a blip with regard to their performance on indices? Of course, they IPO'd very well, but thereafter we saw a bit of a blip. So have you advised them at all? What was your advice? What advice did they seek from you?
This was similar, which is let's be conservative. But you must remember that both those companies did very well post-IPO.
Yes.
It's only when the market corrected globally, the tech, when the Fed began to contract the balance sheet, when the market corrected globally, and then the Indian market corrected, then these two companies corrected. And then they came back strongly.
Understood.
Okay, so I would say they both had good, successful IPOs, including in the aftermarket.
Right. And do you believe that both of these companies, in terms of your investment as well as in terms of their path to profitability, have overachieved what you would have thought of when you invested in them?
Not in 2010. If somebody told me that, listen, Zomato will be between $25 and $30 billion, I would have said you're smoking something. Right? Likewise for Policybazaar. So you can't predict the future. The question is, you stick with what you see, which is, are the founders good? Is the idea good? Is execution good? Can they make it happen? Now, what eventually turns out, you don't know.
You make it sound so simple, sir, but frankly, it's so hard to do. As we see with most investors, it's extremely difficult to do.
No, you got to stay a long time. You got to understand one thing. Most VC funds are 8 plus 2 years, 10 plus 2 years, right?
Yes.
But for a company from inception to IPO, very often the journey is 12 years, 14 years, 15 years, and then in the aftermarket, 3, 4, 5 years more. So, but you don't have 20-year funds. We had the benefit of being able to invest from our balance sheet, and therefore we can stay forever. And a lot of the value creation, now we went into Policybazaar in 2008. It's now been 16 years, we're still there. We went to Zomato in 2010, it's now been 14 years, we're still there. If we'd been a regular VC fund, we would have wanted to exit by 2016, 17. And we would not have realized this kind of value. So we are looking good because we waited this long. We are looking good because of the founders, because of the management team, because of the work they did. We are lucky and fortunate that they allowed us into the companies. So our contribution is a lot less than the management teams and the founding teams.
Right. So, your story is truly unique. You started off as an entrepreneur, started with Naukri. Thereafter, did a bunch of other very similar consumer tech startups, driving technology through InfoEdge. And thereafter started as an investor, started a completely new journey. That's so difficult to do. Just talk us through what possibly was your most challenging, one or two biggest challenges you faced in this journey.
So what happened was that we had IPO'd in 2006. We had this cash sitting on the balance sheet. And more cash, we were profitable, more and more cash was coming in every month. And the board said, listen, you better use this cash. You can't just let it sit there. So it was decided that why don't we invest in startups? Now, that was given to me as an add-on assignment in 2007. I was still the CEO of the company then. And I was told that you can invest up to 160 crores next 3-4 years in startups. Now, by today's standards, that's a small sum of money. But at that time, it was a big chunk of our treasury. In the next 5 years, we invested about maybe 200 crores across 7 or 8, maybe 10 companies. 2 of those were Zomato and Policybazaar. In 2010, I stepped aside as CEO and looked at investing full time. My biggest challenge then was, do I really have a job? But as the portfolio grew, it kept taking up more and more time. And I, over the years, made it a full-time job.
So what made you switch from founder to investor? You said you did that in 2010. So what made you do that?
I think the other leadership in the company was ready to take over. The company had told me that, listen, there needs to be a succession plan. So I was 47 when I quit as CEO in 2010. And Hitesh was ready to take over, and he took over, and he's done a great job. So if you look at the market cap of InfoEdge from 2010, when Hitesh took over, to now, I think there has been a massive, massive increase. And all thanks to Hitesh and everybody else, and less to me. Of course, to some extent, Zomato and Policybazaar do contribute to market cap. But really, that credit goes to the other founders of Zomato and Policybazaar and the management teams there. Now, there are close to 100 startups we invested in. Some of those will succeed and are succeeding and are looking promising. So I think over the next few years, we hope 1 or 2 more successes come out.
Right. So if I were just to zoom out, 1997, you started Naukri. What was the mindset at that time?
So I quit my job in 1990, right? And for the first 7 years, I drifted and did 20 small things. Naukri was the 21st small thing. It just turned out right place, right time, worked hard, worked smart, got lucky. We had tailwind. The internet grew, we grew with it. We were able to raise venture capital just before the meltdown, and we were able to then grow the company through the meltdown, break even, make a profit. I think a lot of the credit goes to people other than me. I just happened to be the founder or the CEO at that time. And so I got to go on stage to accept all the bouquets. But really, it's about a lot of other people in the company who have done a lot of the heavy lifting.
Right, and you diversified thereafter. Of course, Naukri still contributes nearly 3/4 of top line, but you diversified after that.
Naukri contributes probably 140% of bottom line. That's most important.
Absolutely. No, I take your point, but what got you to diversify, sir?
So we launched Naukri 97. And it was going along, doing couple of lakhs a month sales. We were breaking even. I wasn't taking a salary. I told the head of tech, the CTO, Anil Lal, I told him, we've done one category in print, which is jobs. Why don't we do a second category, which is matrimony, right? So he said, okay, I gave a brief. He did a site. We call it Jeevansathi. We let it float. We did not devote any resources to it. We had no resources. When we raised money from ICICI Venture in 2000, April 2000, they said, listen, what is this matrimony site? Just shut it down. Just focus on Naukri because that's what we invested behind. And also, we want a new auditor. Your small auditor will not do. We want a big five. So I went to our then auditors who had been with us for 10 years. And I told them, listen, I'm very sorry, but just one second. I'm very sorry, but we have to part company because we need to appoint a big five auditor because that's what our investor is saying. So we are going to Pricewaterhouse. So we'll have to part ways. And they told us, hey, no problem. We were thinking of shutting our CA practice and starting a .com anyway. It was bubble time. So we said, great, why don't you take Jeevansathi? And we gave them Jeevansathi to run at almost no cost to them. But we retained a minority shareholding of maybe 45%. Now, meltdown happened. They couldn't raise capital. They worked at it for 3 more years. They were again breaking even, bootstrapping. And meanwhile, Naukri managed to grow and turn around and make a profit. And in 2004, we went to them and said, listen, you've not been able to sort of make it scale. Would you like to sell it back to us? And they said, sure thing. We agreed on a price. They made some profit. And we bought Jeevansathi back. And that's how we diversified, as simple as that. And once we diversified into matrimony, the next logical choice was real estate and then education, because they were big advertising categories in print. We were essentially following the print advertising market and say, where is the money coming from? It's jobs in classifieds. It's jobs, it's matrimony, it's education and real estate, and we did all 4 categories. So that's how we diversify.
Right, and do you intend to even now scale some of those? Do you believe that they'll contribute significantly to InfoEdge going forward?
Well, we hope so. We are persisting. We are getting growth. I think Shiksha is broken even.
Yeah.
I think Nike is cut burn, Jeevansathi is cut burn.
Yes.
So good things are happening, but let's see how it goes in the future.
Right, and do you believe also that maybe at some point you'll extract value from them through separate listings, or do you believe that InfoEdge will continue to be the parent to a lot of the investments that you're making?
So as of now, there are no plans to demerge any business of ours. What the future holds, I don't know, but as of now, there are no plans.
What do you think are contributors to the InfoEdge story and the success that it has been? Of course, there have been several contributors all triggering at the same time to get you where you are. But what do you believe are the 2-3 key ones?
I think number one is people. The people we have, the leadership team, leaders down the line, there are currently 5,500 people working in the company. There must be another 5,500 who have worked in the company in the past. They have all contributed. So I think it's about people, really.
And what do you think in terms of, because you focus so much on the people aspect throughout this conversation, what is it that you look for when you're hiring? Maybe someone immediately under you, or someone that you believe, say, Dipender is hiring, what would you advise him? What's the kind of person that he should look for?
I think you need people who are capable and committed and have integrity. Now, those are broad hats.
Yeah.
Now, you go specific and you say, fine, when you say capable, what kind of skills? It's different for different jobs and different for different levels in the organization. But as you grow, go higher in the hierarchy, I think while you have to go technically, you also have to be great with people. And that's important.
Right. Jobs of the future, sir. You work with AI even now. You've got investee companies which are AI based. What do you believe? And you run Naukri. Just so happens. What do you believe are going to be the jobs of the future and the skills of the future that one needs to equip oneself with?
So look, some of the bread and butter jobs remain the same. Sales, operations, customer service, large numbers being hired there, even now. And that's not going to change. I think within tech, you're looking at different skill sets. I think today AI/ML jobs are people are in great demand. Like tomorrow it may be something else. Maybe some of the older skill sets may come back as IT services comes back, which it might. So yes, there'll be ups and downs, but and there'll be a few emerging areas for jobs. But by and large, the 80% of the jobs will still be in the traditional areas.